What is going on, investors? This is Jason, aka the Frugal Investor. This video will be full of a lot of value on some of the most important concepts of investing like risk, moat, and margin of safety. This video can change your perspective on investing, value investing, and long-term investing. Please like and subscribe. Go ahead, like and subscribe. Sit back, relax, let's get started. As a value investor, the first thing that you have to think about before you start investing is risk. How do you manage your risk? Warren Buffett says the most important rule of investing is number one, do not lose money. Number two, do not lose money. Number three, look at rule number one and rule number two. How are you managing your risk while you are investing? If someone is telling you the more risk you take, the bigger you win, it's false. In the markets, the less risk you take, the lower downside and the more upside is the biggest winner. And you do that over and over and over. Efficient market hypothesis is also completely false. There are inefficiencies in the market. That's where value investors look for value and make money. The market is there to serve you, not to tell you how to invest, not to guide your emotions on putting money here, over here, or in this cycle or in that cycle. It is there to serve you. You have to look for the value and use it to your advantage. Always play the safe game with low downside and massive upside. And that is where the game of moat and margin of safety comes in. The first concept is risk management. Always know where you can die and do not go there. Now, within risk management, there are two ways to manage your risk. Number one is moat, and number two is margin of safety. What is a moat? Let's talk about it. In the words of Warren Buffett, a moat is a castle in the middle of water with huge walls, with guards guarding it at all times. This castle is almost impossible to breach, and that is what a moat is. In the world of business, a moat is a business that cannot be replaced. It is almost impossible to breach the walls of that business. For example, Google. Google has a monopoly on search engine, and that helps it to give it a moat to become the biggest advertising agency in the world. Facebook has a moat of its 1.9 billion daily active users that helps it to become so valuable. A company that has an unfair advantage over its competitors, which is almost impossible to replace, that is a moat. Think about two businesses right now, other than Google and Facebook, in your mind that are like a castle, that are surrounded by water with guards guarding the huge walls. That is almost impossible to breach. Think about it and write down in the comments below. Facebook and Google, I gave you two. Now you think about two businesses that cannot be replaced by their competitors that have a huge moat. Reiterate what we talked about so far is managing risk. The first concept in managing risk is moat. Managing risk is super important for a value investor. You do not want to lose money in the market. And that is the first concept that you have to think about when you are building a portfolio or when you are buying a business. Before you make a move, think about the risk first and prepare yourself for that. Now, the first pillar was moat. Now, let's move on to the second pillar, which is margin of safety. During the dot-com bubble, most of the tech companies were wiped out clean because they did not have a moat around them or a margin of safety while purchasing them. While the investors were buying those businesses, there was no margin of safety. They were at sky-high prices, and there was no P by E ratio counting. There was no value analysis. They were at sky-high prices, and it was all speculation. The good companies that had a moat around them survived the dot-com bubble, and they are still around today. Example, Microsoft. A margin of safety is a buffer that protects your principal if the stock market enters into a bear market mode or goes down. It's a crash, it's a depression. It protects your principal amount. Now let's untangle the weeds from this concept. Let's say you're jumping from a height of 4 feet. When you are jumping from a height of 4 feet, would you prefer jumping on a concrete road, or would you prefer jumping on a foamy, cushiony top with sand on the base? It's foamy, cushiony top with sand on the base, right? That is margin of safety. That sand and the foamy, cushiony top is your margin of safety, while the concrete is, it has no margin of safety. In the business terms, the concrete is the companies with high valuation, with speculative rates, with speculative prices that you enter in, and there is no margin of safety. There is no real value, no real earnings supporting your price. While the foamy cushiony top is when you enter into a business at the right price. You know what the future earnings will be for the next 3 years, 4 years, and you calculate your price based on that. And then you make a move on the business. That is, that company will grow when the earnings grow in the future after 3 years, 4 years, and that will be your margin of safety, that growth, that buffer. Your principal will be safe, but whatever the growth will be for the next 3, 4 years, that will be your margin of safety. For example, my purchase of Facebook. My purchase of Facebook was at a price of $295 back in November of this 2020 previous year. At $295, it had an earnings of $10.22 per share. My P by E ratio was 29. Now the P by E ratio was high, but I counted the earnings for the next 3 years. I gave it a reasonable growth of 25%. While the growth has been almost 40%, I gave it a 25% reasonable growth over the next 3 years. And based on that, I count the earnings. Based on the earnings, I came up with a price of $400 for Facebook, and while it was available at $295 when I bought it. So it was at a huge discount for me. Currently, it's at $376. It's still available at a discount. However, the P by E ratio is 27. But don't look at the P by E ratio for now. Look at the earnings, the future earnings. How has the company been doing in the past, and how do you expect the company to generate cash flow till the lifetime of the business? And based on that, come up with a price, P by E, price by earnings ratio, and that price will give you a aspect of if you are investing with a margin of safety or if you are buying at a sky high price. My purchase of Facebook was at a future P by E ratio of 20. And if you go 3 years ahead and the company continues that moderate amount of growth, which it has been doing for the past 5 to 6 years, my P by E ratio will be less than 15 over the next 5 years for Facebook. To reiterate, when buying a business, always look at the value. Stay away from the hype. Stay away from the hot stock of the day. Look at the value. Project the earnings in the future. 3 years from now, 4 years from now, based on moderate earnings adjustments, how much will the business generate you in cash flow? Based on that cash flow, come up with a price. I will make a separate video on this channel, how to come up with a price, how to calculate the intrinsic value of a business. But look for value. If you look for value in a business, you think that this will generate more cash flow during the lifetime, and based on that you come up with a price. For example, I came up with a price of $295 for I came up with a price of $400 for Facebook. That will give you a margin of safety. That's the concept that we talked about. Now overall, first look at the risk. What is the risk when you are investing in Facebook, for example? What is the risk that you are investing in Facebook? Lay them down. In my case, Facebook, it did not look like a risky concept at all. It has 1.9 billion active daily users, and it is growing in all the countries around the world at a very fast pace. They are now in 4 major platforms across the world. That is, it has a huge moat around it. Okay, it has a huge moat around it. There are very less places where I can get in trouble, and those places I'm going to stay away from. Now I got a business with low risk, with a huge moat around it, and then a huge margin of safety, which is the earnings will continue to grow, and the price was available at a good price, $296 at that time, and the price will have to match the earnings over time, and I will come up as a winner with this stock. That is the concept of risk management It's two pillars, which is moat around the business. That is, this business is irreplaceable in what they do, at least for the next 5 to 10 years. And the second thing is the margin of safety. Buy it at a price where the earnings in the future can grow and grow with the price can grow with that. Such is the importance of managing risk, having a moat around the business that you buy, and also having a margin of safety. That is it for this topic, guys. Please don't forget to like and subscribe. This is the Frugal Investor, and see you in the next one.